All right, let's pull back the curtain on one of the most talked about, but also one of the most mysterious corners of the financial universe, hedge funds. You hear about them all the time. They're secretive, they're super high stakes, and honestly, for most of us, they're totally off limits. So, what really goes on inside? Let's find out.
I think the best way to picture it is like this. If the stock market is a giant public park that anyone can go to, a hedge fund is the exclusive, members-only VIP room hidden in the back. And let me tell you, the bouncer at the door is very, very strict. So, what's the big deal about this club?
Okay, so here's the official textbook definition. A couple of things really jump out. Privately offered means you're not going to see a Super Bowl ad for a hedge fund. You have to be invited in. But the real key phrase here is aggressive strategies. That's what it's all about. We are talking high-risk, high-reward moves that are designed to make money whether the market is going up, down, or sideways.
So, who's actually in this VIP room? Well, it pretty much boils down to two groups. You've got the general partners, or GPs, they're the brains of the operation, the ones making all the investment calls. And then you have the limited partners, or LPs. They're the ones with the deep pockets, who provide the capital. We're talking millions, sometimes billions of dollars that fuel this whole engine.
Now, the best way to really get a handle on what a hedge fund is to compare it to something you're probably a lot more familiar with, a good old mutual fund. So let's see how this exclusive club really stacks up against the everyday option. And here it is, the core difference in a nutshell. A hedge fund is a private club with a very, very exclusive guest list. A mutual fund, on the other hand, its doors are wide open to the public. You, me, pretty much anyone can walk right in and start investing. And this is where the differences get really, really stark. I mean, look at regulation. Mutual funds are heavily regulated by the SEC to protect everyday investors. Hedge funds, they operate with way less oversight, which gives them a ton of freedom. And that freedom is what allows for those aggressive and flexible strategies you see here. Using borrowed money, betting against stocks, these are moves a normal mutual fund just isn't allowed to make. But that freedom has a trade-off. Look at liquidity. It's low. You can't just pull your money out whenever you want. It could be locked up for years. And this right here, this is the price of admission. It's the famous, or infamous, 2 and 20 fee structure. How it works is managers take a 2% fee on all the assets they manage just for showing up. And then they take a whopping 20% cut of any profits they generate. This structure creates a massive incentive to take big risks to chase those huge rewards.
So, all of this brings up a really important question. Why is the bouncer at this club so tough? Why can't just anybody get in on this? Well, it all comes down to something called the Accredited Investor Rule.
The logic here is actually all about protection. Since these funds have fewer safety nets and use these incredibly risky strategies, the government basically steps in and says, look, we're only going to let people play this game who are sophisticated enough to understand the risks and, frankly, wealthy enough to absorb a total loss without it completely ruining their lives.
And here they are, the specific keys to get into that VIP room. You either need a consistently high income, we're talking over $200,000 a year for an individual or $300,000 for a couple, or you need a net worth of over $1 million. And that doesn't even count the value of your main house. The message is pretty clear. You have to be able to afford to lose it all.
Okay, so let's say we've made it past the velvet rope. We're in. Now we get to peek inside the playbook and see the actual strategies these managers are using to try and generate those massive returns. This is where it gets fun.
The first, and maybe the most classic hedge fund strategy, is called long-short equity. This is really where the hedging part of the name comes into play. It's all about playing both sides of the market at the exact same time.
The whole concept is a brilliant balancing act. A manager will go long on company A, buying its stock because they're convinced it's a winner. But at the same time, they'll short company B, borrowing shares and then selling them, betting its price is going to fall. The goal is to profit from the spread between how the two perform. The real beauty is, if the entire market crashes, that short position is designed to hedge or protect against the losses from the long position. Pretty clever, right?
All right, now not all strategies are about picking winners and losers. Some, like merger arbitrage, are all about exploiting specific events. The easiest way to think about this is placing a really calculated bet that a corporate wedding goes through without a hitch. So, let's say Acquire Co. announces it's buying Target Co. for $50 a share. Right after the news breaks, Target stock might jump up to, say, $48. That $2 gap is called the spread.
The hedge fund swoops in, buys tons of stock at 48, betting that the deal will finalize, and they can cash out at the full 50. Now that might seem like a small profit, but they do it with millions and millions of dollars. The big risk? If regulators block the deal or it just falls apart, the stock price can absolutely plummet.
Our last strategy is maybe the boldest one of them all: global macro. This isn't about picking individual stocks. No, this is about making huge, sweeping bets on the entire global economy. We're talking interest rates, currencies, political events, the whole shebang.
You might have heard stories about George Soros breaking the Bank of England. That's a legendary global macro play. It's when a manager analyzes these huge global trends, forms a really strong opinion, like, say, a central bank is about to hike interest rates, and then makes a massive bet. In this case, they might take a huge short position on that country's bonds. If they're right and rates go up, bond prices fall, and their fund can make an absolute fortune. It's a high-stakes game of economic chess. So we've seen the exclusivity, we've seen the crazy fees, and we've seen some of these high-stakes strategies. What does it all add up to? What's the bottom line for the people who invest in these things and for the rest of us?
It really boils down to high-stakes trade-off for a very specific type of client. We're talking extremely wealthy people and large institutions like pension funds. The potential pros: huge returns and diversification away from the regular stock market. But the cons are equally massive: immense risk, those sky-high fees we talked about, and having your capital locked away, sometimes for years at a time.
And that leads us to probably the single most important takeaway from this whole explainer. Given the risk, the complexity, and the lack of protections, hedge funds are absolutely 100% not a place for the average person's savings. This is a professional, high-stakes game.
So I'll leave you with this question to chew on. Are these exclusive, high-risk, high-reward funds a necessary feature of a dynamic financial system, maybe providing liquidity and taking risks others won't? Or are they a flaw, creating a two-tiered system that just benefits the few at the potential expense of the many? It's a debate that really sits at the very heart of modern finance. Thanks for tuning in.